Rajeev Thakkar, Chief Investment Officer with PPFAS, joins us now to talk about markets and to talk about how he's investing in this environment. And I must just bring this point out for our viewers. It's been such a privilege tracking this scheme. It's got not a very long history in terms of a mutual fund presence. Very small beginnings. Started with an AUM of less than 500 crores. Today, I've been told that they're managing 20,000 crore. Single focus, just one equity scheme, little bit of diversification, and look at what they've achieved in terms of very simple principles. So Rajeev, it's so heartening. I mean, आपकी कहानी तो हमने देखी है. So nice to see that.
Thank you so much for the kind words, Ekuj.
It's what, 20,000 crores now?
Equity scheme is 45,000.
Oh, I thought 20. My bad. 45,000 crore of equity, and you started in 2012. 13, and you started with 100 crores.
Yeah, NFO was less than 100 crores, but overall within a short span, we were at 300 crores. That was the PMS AUM prior to the shift to the fund.
Saying that you've been a multi-bagger, right?
Yeah, you could say that.
Okay, great. So nice to hear that. So a scheme which itself has become multi-bagger. Let's talk about the next multi-baggers they are betting on. Let's keep multi-bagger only as a theme. Diwali hai, multi-bagger theme rakhte hain. Your schemes have become multi-bagger, which are the stocks have become multi-bagger, and which are the stocks which could become multi-bagger according to you?
So, sorry to be sharing some bad news in that sense. I don't have too many multi-bagger ideas to share. Firstly, as it is, we are not allowed to give stock recommendations, you know that, and it was a trick question from your side. But overall, I think we are coming out of a 20-year period of falling interest rates, and rates have started moving up globally, and there was a valuation creep overall. So all asset classes world over went up in valuation. So at a time when, let's say, US bond yields are around 4 to 5% and threatening to go higher and for longer, I don't think one should be really looking at hitting sixes right now. It's cricket season as well, apart from Diwali. I think people have made good amount of returns in the last few years. Not last 2 years, but maybe if you look at it from a 5-year perspective, I think it's time to be more conservative in terms of the future outlook. I don't think it's a time to be very, very aggressive in terms of investing.
Is it because of valuations? Is it because the way you think economy will evolve? Is it election risk? Why do you say that?
Sure. So I'm not talking about any event risk or macro. I'm not talking about the conflict in Israel or the conflict in Russia and Ukraine or elections and things like that. My thing is simple. See, for a very, very long time, fixed income investors were getting a raw deal. What they were doing is they were effectively subsidizing governments, and they were subsidizing corporate profits, the corporates who were borrowers. Now the tables have turned. We are in a positive real rate environment, and borrowers will have a pinch, whether it's a corporate borrowing money or whether it's a individual who has taken a mortgage loan on floating rate basis. We have seen EMIs going up. That will somewhere affect consumption down the road. That will affect things like real estate prices, real estate sales, auto sales. This is, I'm talking from a global context, developed world largely. So somewhere all these things will have an impact, and the gradual creep in valuations that we saw, it at the broad level, it may not seem expensive. So a Nifty 21 multiple may not seem very, very expensive. But when you look at the individual company valuations, some trading at 70, 80, 100 times earnings, or some of the newer listings coming on, prospects of future profitability and just focusing on growth, I think that environment has changed, and one should be cautious on that front.
Holdings right now, they include names like ITC, Bajaj Holdings, ICICI Bank, HCL Tech. There is no pattern here. I mean, it's not that you've got very large concentrated bets in IT or pharma or financials. Has that been done on purpose, that you are not, in a sense, following the benchmark per se?
We have not been following the benchmark since day one. So from that perspective, it's nothing new. So we are we have said that we are an active fund. We will go where we see the opportunities, and we will not worry too much about what is the weight in the index at that point in time. So these names, some of these names have been around for a while now in our portfolio. So Bajaj Holdings has been there for long. ICICI Bank, HCL Tech has been there for long. So uh, in post-COVID, we actually moved out from small and mid-cap IT to larger IT names. So that's where something like a HCL Tech finds position. ITC was a contrarian purchase a while back when people were not looking at it. It ran up quite significantly. So we have trimmed some weight over there. But otherwise, these names have been around for a while. Coal India would be a more recent addition in that sense.
Also wanted to get a sense from you into which sectors are you adding your weights? Is it those underdogs, the likes of pharma sector, where you are adding position, or sticking with financials of the world?
I think almost any person that you get on the show, almost anyone from my colleagues in the fund management in the industry would say that banks are looking attractive in terms of the valuations that they are trading at and in terms of the clean balance sheets that they are having. The challenge that the fund managers are having is that banking as it is a large portion of the overall market cap and overall index. And any fund will not go overboard in just one sector. So to that extent, people are having to limit their exposure to the banking space. But I think banking is looking very, very attractive. You mentioned pharma. So pharma has not done well for last few years, and valuations are looking attractive. And even on the business side, some of the challenges that they were facing are increasingly behind them. So that space is also looking interesting.
Rajiv, but the
Auto
thing
is
with
another space which is coming
Sure.
out of a long period of low growth or no growth kind of environment. That is one other space which is looking good.
Right. So let me pick up on each of those spaces one by one, Rajiv, because banking is getting pretty diversified. PSBs are chugging along in a different trajectory. ICICI Bank, of course, is in a different orbit, but I can't say the same about an HDFC Bank or a Kotak or many others as well. Where within banks is your tilt?
So, to my mind, there are five banks in India, four in the private space and one in the public space, which have done well in terms of having a full range of product offering, having a good CASA share, having a well diversified product portfolio, well diversified branch network. So I think that is a space that we are looking at. Some of the banks that you mentioned, where because of a reason where they have taken all the credit losses in the past and now they are not having to provision so much, they may be looking attractive in terms of price to book or price to earning basis. But the challenge is that many of them are ceding market share to the five players who really lead this space. So I would not go purely tactically in terms of looking at the current result numbers and investing in them for a short period of time. Really, these banks which are gaining market share are the banks where we are investing in. So we have three private sector banks in our portfolio, and that's where we are invested.
4% higher for DB Realty. They've sold Real Gem Buildings to Rustomjee Group. Now, DB Realty was this, it's a Mumbai-based real estate company. They ran into a lot of trouble. They got, they've got a, unfortunately, if you look at the news and where DB Realty cross connections were with what happened 10 years ago in terms of the telecom scam, that is something which markets did not like. Are they on the comeback trail? Are they looking at revival their businesses? They're trying to rebuild the franchise, but let's see what happens. It's too early to pass on a verdict. By the way, in this company, I think 2 years ago, Rakesh Junwala had made an investment through a right issue or something. Rajiv, is it time to buy into real estate sector? The stocks have even done rather well, but this is a sector where RERA is at play. All the Do number has become ek number, if I may use the word. Corporates, real estate companies are clean in terms of corporate governance now. And instead of dozens of real estate builders in India, now there are few big ones only left.
Nikunj, the bull case can be made at any time in the last decade or 2 decades, but the experience of public market investors has not been that great in this space. We watch it periodically, but we are not big fans of investing in this sector. And again, here, see, if you are buying a FMCG company, things move like clockwork. So if you are buying a soap manufacturer, you know that this much soap will be produced and sold, and this will be the kind of margin, and this is the ad spend, and that's about it. Here, you have to have a view on project by project basis. So just for example, a Mumbai-based real estate developer could be doing very, very well in the western suburbs, and then they may get stuck in uh, a project in mid Mumbai, and then what was looking hunky dory becomes suddenly very, very challenging. Then you have all these CRZ regulations, or sometimes some thing gets stuck in litigation and this and that. So we have been hearing consolidation and asset light model and unorganized to organize, all that we have been hearing for a while, but yeah, we'll probably give it a pass.
You've avoided, let's say, at least the portfolio which we have in public domain. You don't have high exposure to the so-called fashionable names, defense, power, railways. These are the so-called mega trends.
Sure. Uh, in fact, it's very interesting, Nikunj, that you asked this question. I just wrote a note on this to our unit holders for the forthcoming unit holders meeting, and where we'll just release it in a couple of days. So the one line from the note goes like this: Benjamin Graham, more than 5 decades back, said, obvious prospects for physical growth do not translate into obvious profits for investors. Now, it's a very, very powerful line. And in the Indian context, if we go back in the past, in the early to mid 90s, two sunrise sectors, growth sectors would look like private sector airlines and would look like the new mobile telephony companies that were launched at that point in time. And there was obviously hype around these sectors. And fast forward a few years, and those sectors did not really do too well for equity shareholders. So apart from volume growth and opening up of a sector or good tailwinds, what also matters is capital efficiency, management and promoter quality, how much leverage they are taking. Is it a very, very competitive sector where, or is there a scope for some pricing power? So all these things also have to be looked at in conjunction. So you are right. We are not participating in some of these fancied themes just blindly, and we are taking our time looking at the companies.
Sure. I think you've recently also reduced your weight, Raji, on the likes of Coal India, Power Grid, etc. Is it a tilt against the public sector entities, or is it that you think these are now overvalued and the power rally is pretty much factored in?
So I would not read too much into the some small selling that you would have seen. So many times it's driven by the portfolio weights that we are looking at and things like that. So I would not read too much into it. But we continue owning these companies, and it is what it is. So sometimes, so again, this is public information. We do have this covered call strategy in some of these companies, and sometimes the sale may be purely a reflection of that.
IT, Rajiv, I understand that with power there might be a bit of a portfolio management there, but what's your structural call on IT?
I think near-term challenges are there, but broadly the space is one where the management quality is pristine. Again, they don't have too much borrowing. In fact, most of them are net cash companies. So we are looking at it beyond the current cyclical downturn. I think they will be back on the growth trajectory in a few years, and we are staying put for that, and we are staying invested in the IT space.
Rajiv, earlier you flagged off your preference towards autos as well. Again, diversified as the sector may be, what's the preference within autos?
I think the four-wheeler space looks interesting in autos. So while entry-level cars have not been doing too well, but the selling price per car has been going up, and again, margins are improving and those kind of things. So I think right now the mid to premium segment is doing better than the entry level vehicles, but soon enough you'll probably see demand coming back to the entry level as well. So four-wheeler space is where we are invested in.
Rajiv, great to have you on the show. Thank you so much for taking the time out, and here's wishing you a very happy Diwali from all of us.
Thank you so much, and happy Diwali to you and all the viewers.
Thank you so much.